I'm Igor, and with me here today is Nina, Irina, Andrei, and us. We issue a buy recommendation with a one-year target price of 88.92 Swiss francs, representing an 11.4% upside from its closing price as of 29th of December.
Our recommendation is based on the stock's undervalued market position and stable historical performance. Share price downturn at the end of 2018 was a significant deviation from its intrinsic value, creating an attractive opportunity for a value-seeking investor. With 52-week price range of 16.4% from the average price of the period, Nestlé appears to be the least volatile stock among peers. Considering the blue-chip nature of the stock, it is a good option for value investing strategy and investment portfolio risk balancing. Therefore, the company is a reasonable choice for a risk-averse investor. Moreover, our buy recommendation is supported by strong competitive positioning, stable financial performance, affirmative valuation outcome, and effective risk management.
Let's start with key competitive advantages of the company. Nestlé is the world's largest food and beverage company with the annual sales of 90 billion Swiss francs. It operates in 189 countries, which are grouped in 3 geographical zones. Nestlé's product portfolio is represented by 2,000 global and local brands, which are categorized into 7 product lines.
The company's corporate strategy is based on 3 core pillars. Firstly, Nestlé is increasing product portfolio efficiency by concentrating on 4 outperforming divisions: powdered and liquid beverages, nutrition and health science, pet care, and waters, which show the highest organic growth across the company and generate 57% of total sales. Secondly, selective mergers and acquisitions allow Nestlé to boost non-organic performance and increase market presence. During the last 2 years, Nestlé has conducted numerous targeted acquisitions. We expect that the $7 billion license deal with Starbucks will increase Nestlé coffee segment performance. At the same time, the company is divesting its underperforming units. Finally, to maintain leadership positions, Nestlé accelerates innovation as the main area of success. The company allocated the highest R&D spendings in the industry, reaching $1.8 billion in 2017. In line with health and wellness strategy, Nestlé targets nutritional division as the main area of research, assigning 60% of all R&D budget.
The global food and beverage industry is characterized by high competition, with the 20 biggest players controlling only 9% of the market. We determined our closest peer group by intersection of companies' product lines, financial metrics, and geographical presence. Our analysis shows that Nestlé doesn't have any rivals that exceed its size by revenue and market capitalization. However, we observe that Nestlé and some of its peers have moderate or even negative revenue growth, which is explained by the influence of fast-changing consumer tastes.
Some of the trends, such as healthy diet, sustainable production, and premiumization, target the whole industry. Others challenge specific segments. We expect that the overall impact of the trends will result in a mid-single-digit growth for all product segments in the industry. Through effective diversification strategy, Nestlé manages to benefit from changing trends by upgrading its product portfolio and hedging their negative impact on sales.
And now, let's turn to the company's financial analysis. Stable financial performance is ensured by the elaborate financial strategy comprising profitability targeting, supplier financing, effective debt usage, and stable dividend payout. Let us consider each one in more details. We provide a positive outlook on the company's earnings with a CAGR of 2.8%, driven by strategic focus on 4 high-growth product lines. The decrease in administrative, manufacturing, and procurement costs will improve company's margins. At the same time, our forecast does not confirm Nestlé targets on operating profit margin and cost savings amount, implying more conservative outcomes. Nestlé uses supplier financing as an interest-free way to fund its operations. The company achieves this aim through maintaining a negative cash conversion cycle with subsequent decrease in working capital. The gap between operating cycle and DPO allows Nestlé to keep cash generated from sales longer. Driven by raising trading liabilities, working capital decrease indicates the company's intensive utilization of supplier financing. Such an effective operational management allows Nestlé to allocate operational resources more efficiently.
Nestlé uses buyback programs as a way to improve investing attractiveness by increasing earnings per share and dividends per share. Our analysis shows that the company does not generate enough cash to fund share repurchase. financing the ongoing program by debt, the company estimates its net debt to EBITDA ratio to increase from 0.8 in 2016 to 1.5 in 2020. Considering the lowest debt to equity ratio among peers, the expected debt increase will not harm Nestlé's financial health. Nestlé also applies a stable dividend policy at the constant annual growth rate of 5 centimes per share. The key feature of the policy is that DPS is independent of net income. This allows the company to ensure growing return for investors in unstable market conditions. In the forecasted period, we expect a further stable dividend rise in line with the company's payout strategy.
Nestlé's stable financial performance leads to our conservative valuation outcome. Our target share price of 88.92 Swiss francs reflects the intrinsic value of the company, derived using fundamental two-stage DCF-FCFF model and confirmed by a relative EV/EBITDA multiple approach. In our target price estimation, we started with calculation of weighted average cost of capital. We estimate the target capital structure of the company, as well as cost of debt and equity, resulting in 5.73% WACC. To derive enterprise value, we calculated free cash flows for 5 years and terminal value using Gordon growth model. When discounted and added, free cash flows and terminal value comprise total cash flow available to creators and shareholders. Finally, we divided the derived equity value by the current number of shares outstanding to arrive at our target share price of 88.92 Swiss francs.
In order to check the correspondence of our fundamental approach and market view on the stock, we compared Nestlé with its peers using forward-looking EV to EBITDA and EV to sales multiples. Having defined our peer group, we derived target price ranges which are in line with our fundamental approach. We also performed a Monte Carlo simulation to show the influence of stochastic factors on our model. As key inputs, we have used WACC, terminal growth rate, effective tax rate of the company, and bear and bull scenario assumptions. Having run 500,000 iterations, we observed a 60% probability of a buy outcome.
To complete our analysis, we identified the potential risks which could influence our recommendation. We grouped them into 5 main categories: operational, financial, market, economic, and legal risks. Our research showed that deterioration of economic conditions, private label expansion, and reputation impairments are the most probable and impactful risks for the company. Volatile economic conditions can create a number of challenges for Nestlé's further development, especially in emerging markets. Upcoming recession and the US trade disputes with China, Europe, and Mexico may lead to higher inflation rates and affect company sales volumes. Nestlé hedges this type of risk by having diversified product portfolio and implementing business resumption plans.
Market risks deal with top-branded products, which are becoming substitute to multinational brands. Over 65% of consumers consider private label products to be a good alternative to name brands. However, Nestlé manages to effectively mitigate this issue by strengthening every product line with niche offerings in compliance with recent shopping trends. Finally, such global companies as Nestlé are inclined to face provocations, fake news, or even undergo lawsuits, which can affect the share price. However, Nestlé has an immediate public reaction to any accusations and quickly refutes fake news. This allows the company to effectively mitigate all the reputational issues.
To sum up, with strong competitive positioning, stable financial performance, and 11.4% upside with limited risk influence, we are very confident of our buy recommendation. We invite you to upgrade your investment portfolio with a stable share and permanent dividend payments. Think long term. Choose Nestlé. Thank you for your attention. The team is now open for questions.
Hello, thank you very much for your presentation. You said it's a very attractive opportunity. Do you know what's happened with the stock last week or two when it's dropped like 14%? And what do you think will be, if you know the reason, what will be implications for the company going forward?
So, thank you for your question. If you are talking with the recent drop or in the drop in the end of 2018?
No, it was last week or about last 7 or 8 days.
Okay. So actually, the stock price of Nestlé, the share price of Nestlé stock went up till from the end of 2018, and it reached like from its closing price of 79.8 Swiss francs, it reached 91 Swiss franc. So this was due to the publishing of full year report results, and this was like when the management targets were placed and the investors' expectations about the performance of the company were put. So Nestlé went in line with the targets and went in line with the shareholders' expectations. So there was the rise of the share price.
Yeah, last week, you probably didn't notice, was a huge drop in its peer, Kraft Heinz, and Nestlé also dropped. So what does it mean for the industry and for Nestlé itself?
Well, firstly, as you have noted, 14.1% is in line with our usual average price range, and therefore it is within the usual range of Nestlé stock price volatility. And moreover, when we are talking about the drop of Kraft Heinz stock, we face a situation where investors lack the trust for the company when its earnings results and its forecasts are not as good as they could anticipate. However, we can assure that Nestlé's financial performance is much more stable, and despite this, a recent but very short drop will gain its positions and lead to our target share price.
Thank you very much for your presentation. I have a question on the debt position of the company. You mentioned that the company is less leveraged compared to others. My question is, first of all, why is that? And secondly, do you see any upsides from potential increase in leverage?
Yes, thank you for pointing that out. Actually, Nestlé is now Nestlé is really has the lowest debt to equity ratio among peers. This is because the company uses its debt leverage very effectively when it needs it. So the debt increase that was forecasted by our team is because of the share repurchase program, which is financed by debt, and also the M&A transactions. The last M&A transaction with Starbucks, the last license deal with Starbucks, was also financed by debt. So we see this as an opportunity and as a competitive advantage to the company, having a low debt to equity, having a low leverage, because it has a room to increase it and it has a room to invest and to be more successful and more operational efficient.
Good evening. Well, thank you very much for the presentation. First of all, it was great and it was entertaining. I love the entertaining part. My question is, let's imagine I have a few clients and their risk perception and the risk aversion is different. So if I would, on the basis of your analysis, if I would go back to the client and offer to buy Nestlé, which type of client would that be? Would that be the client that would be seeking for high return? Would be kind of moderate return, or conservative client?
As we have pointed out, we have an example of potential clients that you could offer the Nestlé stock. And to segregate different types of clients, we can say that for the most conservative clients, it would be more reasonable to invest in bonds, for example, which have the risk-free rate. And for more capital gain-oriented investors who wish to have a greater share price upside during the period, we would recommend to also explore other options which have stronger capital gain. However, if you have a client who has a low or medium risk tolerance, and he wishes to both have a capital gain and stable dividend payout, and at the same time have a stable security in his portfolio, Nestlé is definitely the best option for him.
Thank you.
Recently, some of the activist investors were pushing for the split of the company because they consider it too complex and difficult to manage. So what parts of the Nestlé business you are considering more attractive than others, and why?
Actually, we are aware of the fact that one major investor, like Third Point, recently published their recommendation on the activities of Nestlé, and we consider that the strongest parts of Nestlé is their nutritional division because it has the highest organic growth, and also other three divisions which are included in four targeted divisions this year and in the next strategy of Nestlé.
Okay, can you explain me why the company is doing buyback and raises debt for that?
Well, the company uses buyback program to increase its investor attractiveness by lowering the number of shares outstanding. The company increases its DPS and EPS. In the case when the company has a stable dividend, general stable dividend sum of payment, and this payment doesn't correlate as independent from net income, the company manages to increase the return for every single investor without boosting its general budget for dividend payment too much, and therefore both satisfying investors and optimizing its costs, its expenses on investor return. And as for EPS, the company also manages to increase this important for investors metrics by decreasing the number of shares outstanding and therefore generating more return for every single share.
And also I would like to add that in 2018 Nestlé has returned around 10 billion cash to investors, and 30% of that cash was due to the buyback program. So Nestlé increased the amount of cash returned to investors. And as you can see, as you have seen on the slide, so Nestlé uses buyback programs historically to improve its investment attractiveness and to attract new investors and to build trust with investors.
Okay, what do you think stays behind the M&A, quite aggressive M&A strategy of the company, and what's your forecast? How do you forecast is going forward?
Thank you for this question. Nestlé is now focusing on its four main divisions, which is part of liquid beverages, nutrition, pet care, and water. And its M&A is targeted to provide better solutions in these options. Nestlé finds small and medium companies, which are usually startups, to provide new choices for its customers. The company is planning to have some acquisitions in pet care in the future. However, we don't know the exact names of the companies.
So, but we are not forecasting M&A activity due to the fact that the company has no specific targets on their M&A activity in the future. So that it was hard to predict. That's why we're not including our forecast model.
We only assume that this M&A will happen in these four strategic product lines and to boost their performance. So we will do the four focused product lines. And as we can see in 2018, the M&As were connected only with these strategic core product lines. But unfortunately, the company does not disclose information about the specific targets on specific companies.
Thank you. Your time is up.